I bet Dan Hussey would agree with us.
Yeah, that was
Aren't we the
fantastic.
best? You look, we bring guys on like you, and people would call them other people competitors. They're selling services. Have you seen anyone else do something like that where they're giving visibility to competitors?
I really haven't, outside of your major, and I wouldn't call them competitors unless you're talking head on some of the major news channels, right? Which they bring in their typical analysts, but you hear from the same five people over and over and over again, right? So you don't get that fresh flavor that you guys bring to the table either.
Yeah, so, well, maybe competitors, just that they have a service to sell.
Yeah,
We
sure.
have a service
Absolutely.
to sell, and
Absolutely.
we want our people to find the best fit for themselves.
Right. And
So,
there's a lot of
that,
competing, ideas out there. That's what makes a market after all, isn't it?
yeah. And I was thinking about you because I've been following this grain action where I thought it sure looked for a while that we had turned the corner in beans. You still think that maybe we have, and now we're into the growing season, right? Where it's
That's
a real important time frame.
That's absolutely right. Now flip over some charts of the grains right now and give us a quick
Okay,
rundown because hey, why not? Let me see here. There we go. Hopefully everybody can see my screen here. The last
got
few
it.
weeks and months actually for the grains. Let's start with July soybeans. I've got a big daily chart. This is a continuation chart of the soybean. Um,
I see
uh,
corn.
Excuse me, you're correct. There's
Okay,
our continuation chart of
all right,
soybeans, not so different, but you can
right.
see that there's been this $8 to $18 very long-term range since going back to 2010 in the
Yeah,
soybean market.
that's a long
Um, it,
time.
it is, and row crops, corn, wheat, and beans, to be specific here, folks, are pretty temperamental to weather, right, and their production cycles. Which, for those that aren't aware, they're only made once a year in the northern hemisphere. There is a South American crop season that is completely mirrored to our growing season here in North America, but the harvest time frame in the fall is the only time we get real new supply that hits the market. So there is a very cyclical seasonal cycle. So if you like trading cycles and seasonality in charts, boy, you should take a look at agriculture because just inherently by the fundamental, production, they are incredibly cyclical. So what we've
Okay,
seen over the last few years and coming out of 2020 was generally a large inflationary trend that hit row crops and agricultural products just like it did everything else after, we saw the years of cheap money, the massive
yeah,
injections of liquidity after the COVID pandemic. And we saw an inflationary cycle that hit everything, gold, silver, bond market, literally everything you can touch with a dollar saw this type of trend. There, of course, though, was some up and down based off of production just in agriculture, but we have more or less, topped out from that inflationary
yeah.
trend and now
It's
have.
interesting, Dan. Maybe you could address it, but
Mhm.
beans topped out very close to when the wheat did, which was on the invasion and have been down for a couple of years now, trying to base out. Maybe it's come out of here, so they all kind of did the same thing.
Mhm.
But when you show that long-term chart in beans, here's the point I want to make. Um, People say the grains are cheap, and they are relatively from where they were. But look at where they were historically, and these are not cheap grains. I mean, I remember $2 corn,
That's right.
$4
That's right.
wheat,
And I'm going to pull
$5
up the
beans.
monthly wheat. Yeah, here's your wheat chart, guys. This is a monthly wheat chart. So when you say that it's cheap, right, it's relative to these, 10
Yeah,
highs that were $10 per bushel higher. And these big highs in the wheat market correlate to, back in 2022, the Russian invasion of Ukraine
right,
and the,
right.
temperamental wartime market that we had. And
Yeah,
then back in the early 2000s, or excuse me, 2008, leading into the financial crisis, there was another number of things that took wheat higher there. And generally, wheat can be thought of as kind of a flight to safety fear asset at when
interesting.
times get get very, very turbulent because you have to eat, right? And wheat is a
Yeah,
staple food product in every single economy around the world. It's one of the only ones where you can't find a single, a single culture that doesn't consume wheat in some, capacity. So like gold, I like to call wheat,
well,
the
it's biblical.
agricultural gold. Yeah, it is. It is. It
Yeah,
goes
yeah.
back thousands of years
Joseph,
in society.
Joseph knew when to, 7 years of plenty, 7 years of naught. And you know what I notice on that chart? And people that know my work know I'm real big on the number three. I see two spikes in wheat, which implies that there's going to be another one. Doesn't have to
Yeah,
be, but to me, it looks like an incomplete pattern. If I didn't know what it was, that there still could be one more spike left to complete this move over this last 15, 20 years.
certainly. And that could correlate with other inflationary trends in the market that if when I like to measure inflation, folks, I also don't look at the highs in the market. I measure the lows to lows. In other words, that's how I measure the rising tide of inflation. Notice how even
Look
though,
at that.
we
You're right.
spiked up to $13, we never really came back down to the pre-2008 lows around $2 for wheat. Now we spike up to 14 to $15, and we never really come down to this $4 threshold, the
No.
pre-pandemic, lows in wheat. And if we look at the chart of corn on a monthly chart, it's much the same. There's this
Yeah.
rising low, higher low as we progress through the decades. Soybeans are much the same, a rising low as we progress through the decades. Does that mean we can't go down to $8 soybeans? No. It just, I don't know if $6 to $4 soybeans are going to ever be on the table again, just from the 20 years of inflation we've had since, the 2000 era where that was a low. And there's been some major changes, the dynamics of demand for agriculture products. Corn and soybeans are not just used as food products anymore.
Yeah.
They're
Fuel.
actually that's absolutely right, Dale. They're being traded more like energy products. And in fact, over the next 5 years, for specifically for specifically for soybeans, the idea of this sustainable aviation fuel could be an absolute mega demand impact on the market because we're talking about taking I think it's a $4 trillion industry for aviation fuel and trying to convert a lot of that now to biofuels and using soybean oil to create biodiesel and in this case biokerosene, which would be sustainable aviation fuel, could create a massive amount of demand from the energy sectors that wasn't there before. And if we look at a chart of corn here on the monthly chart,
Ethanol.
before, yeah, that's right, before 2010 here, this is the pre-ethanol world for corn. So, the chart for corn used to be a $2 to $4, commodity. After ethanol, now we're a $4 to $8 commodity. So we've just ratcheted up, right, the value of the whole range that we're trading in. And that kind of brings us into, I think, a leeway because into maybe the dollar here, because over this period we've seen similar moves in the dollar, which I
You
think,
know, Dan, isn't it interesting and tragic that we could end up, a lot of people predicting global famine because
yeah,
of weather everywhere, and that we're using food sources for fuel when
yes,
people are starving. It's always bothered me that there are, people that are hungry and we're, uh, you know, using foodstuffs for energy.
yeah, and that's one thing I'll add, I guess kind of play the devil's advocate to that is, which is
Go ahead,
we
you're the
always
devil.
we always need to maintain our demand for acreage for producing the food products, right? We can
Yeah,
quickly shift away from using them for ethanol or fuel and start using them for, other things. However, using corn and beans to produce energy, at least the corn and beans that we produce, corn
are
too,
being
and
used.
they're being used for energy products, but they're being crushed down to take out the sugars to create ethanol for corn, and we're taking the
Okay.
oil from crushing soybeans and making it into biofuel. That leaves over a lot of solid mass. In other words, soy meal, which here's a chart of
Yeah.
soy meal on the monthly chart and a chart of bean oil on the monthly time frame. They're the two components that you get from crushing soybeans. So much
Right.
like you crack a barrel of oil and into kerosene and gasoline,
Right.
or diesel
Great
fuel and
analogy.
gasoline, right? You
Yeah.
crush a soybean into bean oil and bean meal. And the
Yeah.
combination of bean oil and bean meal, and literally on the charts here, should equate to the value of a soybean bushel as well. And so when we create the biofuels from our agriculture products, we're still left with the meal, corn meal, and what is called dry distiller grain from corn, and soy meal from soy products. Those get used in the cattle, hog, and poultry industries as
Right.
food.
Feed.
So we
Yes.
don't waste any of the corn or the bean when we produce its byproducts. They both go into the oil side, effectively the liquid that comes from it goes to producing energy products today. Soy oil does get used as a cooking product too, but primarily goes to be, producing biofuels now. And the meal products go to cattle, hog, and poultry feed. So we are producing food from the rest of that agricultural production, which is a good thing, of course. But it goes to show you the demand, though, for cattle recently has been off the charts,
Yeah.
and I don't believe there is anything, we're for
Unbelievable.
for those that don't know, cattle is a market that is still going through, if you want to call it an inflationary move, that's fine. We are at all-time highs
Yeah.
and pressing into contract highs for cattle right now, which there's been very strong demand for beef. And unfortunately, in the US, we don't have enough cattle
Yeah.
basically to go to slaughter to meet beef demand. On the other side of that coin is hogs, which the daily continuous chart, the daily chart here gives a better picture, I think, for hogs. Here's the daily chart of cattle again. We're
Yeah.
basically in this sideways price action. There's, for all intents and purposes, if you look, where let me go back to the daily
So
continuous here.
the reason for a lack of supply is
Hmm.
there was like a killing off or a culling of the cattle herds in the last few years. Was it disease? And one question that
Hmm.
probably other people have on their mind, Dan, I don't know if it's conspiracy junk or what, but is it true that China has been accumulating a vast amount of farmland here in the
So
U.S.?
Yeah, I wouldn't say, well, it's hard because China does most of their business through home offices. They don't do it, it's not like the Central Party of China comes in and says, hey, we're going to buy of this, this, and this, right? They will open hedge funds effectively, or what are called home offices in the US. Our financial system allows for, foreign investment through these offices so they can almost obfuscate or hide what they're doing. There has definitely been an uptick in foreign-owned farmland, specifically in North and South Dakota, but the percentage that we're finding, at least that reports say, is that it's less than like 2 or 3% of all farmland. So
Okay.
there is not this massive accumulation going on.
Yeah.
There is
You've heard the
certainly
stories too, you know.
Yes, yes. And
Okay.
and 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 by all means, it's certainly a question of national interest. Should we allow our agricultural sector, which is accounts for a massive amount of our GDP, should we allow it for any of it to be controlled by foreign interests? That's another question
Yeah.
for another day, right? Which I don't believe
Right.
they should. But I can understand why China wants to. China's going to do what's in the best interest for China, and China has a food problem. They're not sustainable. They don't have domestic sustainability of their food products, which is why they rely on North and South America for all of their corn and soybeans. Some out of the Ukraine and West Eastern Europe as well, but primarily the hundreds of millions of metric tons of corn and soy produced in the U.S. and South America. The 80 to 90% of that soy production goes to China. So the reason that we, over the last 10 years, have even produced soy is because China wants to buy it. Now that we're seeing this pushback, trade wars over the last 4 years, and certainly, unfortunately, our agricultural sector kind of getting played by foreign interests, we've realized, hey, we need to create some more domestic demand or have a reason to producing this on our own if China were to say, hey, we don't want it anymore. And that's the
Yeah.
big push into aviation fuels and other things.
Someone
Um,
in our community just said that China owns Smithfield, the largest hog producer in the
So
U.S.?
yes, and then our JBS, which is a Brazilian-owned company, owns our cattle markets. So we already have foreign interests in our meat markets, unfortunately, coming in and taking controlling interest of some of the biggest slaughterhouses and producers. Which again, I have strong opinions that I don't believe that's a wise choice, or that we shouldn't necessarily allow that to happen. Even though they are a net buyer and it makes sense in China's supply chain to supply China with hogs, pork, and other protein products. It makes sense for them to integrate. It's much like, I have the same reason why airlines in the US cannot be owned by foreign interests. I don't know if anyone knew that, but we have laws not allowing US airlines to be owned by anyone else but U.S. interests. I would like to see those same laws passed in the agricultural sector because I think they're of the utmost imperative for our own security for food purposes, and because
Okay,
hey, a lot of my clients are U.S. farmers and I want the what's best for them as well, right?
right. Okay, so you wanted to turn to the dollar because
Yeah.
a weak dollar would be supportive of higher grain prices, at least nominally.
That's absolutely right. Because so much of our grain and agricultural products goes abroad, such a large amount of our GDP and our export interests. Um, we rely on on honestly and a well, I've got mixed feelings on how the dollar affects that because China holds a lot of US dollars. So a stronger dollar gives them more purchasing power. But if they're converting, yuan into dollars, a weaker dollar gives them more purchasing power. But uh, yeah, a stronger dollar typically correlates to weaker prices because our export interests go down. A weaker dollar typically increases the purchasing power. They can use less of their yuan to buy more dollars and spend those dollars at the US grocery store effectively. And since 2010, the dollar's been trapped in this uptrend. We've had these 5 to 10 year periods of sideways price action that have broken out. In 2015, we had the first major leg up. We've been gone sideways until through the COVID pandemic. Then we found this rally in the dollar yet again, and have kind of started to settle above the 100 figure in the dollar index. Um, the dollar, I think, is fairly well supported up here, but I also there we go, daily nearest, so we can get the right price data. There we go. But I also think that it's been sitting on this support area where we break below 100 and we're falling right back into the old range we were in, right?
Yeah,
So for the last year and a half, we've had this non-directional sitting on
yeah,
support. Certainly, I think there's the premise that if we break above 106 to 107, we can
yeah.
take the range all the way
Last.
back up.
Yeah,
But we're very much, I think, in a 114 to 100 range for the next 5 years or so, just like we've been. And I'm just pointing out the patterns of the last 5 years that seems to be correlate or seems to be this sideways consolidation, then a major move, because of Fed
right.
policy and other. You point to all of these reasons, you get the big move. Then we set up in a range again. It seems like we had that big move in 2020 through 2022, and now could be in a 5 year period of the dollar going sideways. So I don't have much short term opinion on the dollar just because I think it's been very choppy. It's been this sideways between 106 and 100 for the last year and a half. I kind of foresee that happening until it doesn't. But if we do go above 106, 107, pay attention because we could be setting up in that much larger range for the time being. And if we slip below 100, on the daily charts, because that's what really matters to me, the big macro look to the dollar for how it's going to affect exports. If we
Yeah,
slip below 100, we're going to see that dollar weaken, I think, again. And it's there's a lot of arguments to be made what the Fed will do in its next cycle and if inflation will come back, and all of those things. But I wanted to point out this big chart of the dollar because over the same period from 2020 to 2022 is the period where we would have expected the dollar to be going down when we saw all of these commodities rising in price, right? The inflationary trend, you'd think, wait, doesn't that mean a weaker dollar? And it does, except for the fact that the strength of the US dollar has caused US inflation to be exported and continues to cause US inflation to be exported to the rest of the world. So US consumers aren't getting the full brunt. If anything, our inflation here, and yes, grocery store prices are higher, gas prices have been higher. Everybody sees the effects, but it is nowhere near the effects that we've seen internationally, right? Like in places like Argentina, and all over Africa and the Middle East, and plenty of other economies that have seen a much larger inflationary pressure. And it's due to the fact that the dollar was stronger over this period, and we've effectively been exporting our inflation to the rest of the world. And that happens via a lot of agricultural products too.
Okay, interesting take.
I
Yeah,
saw
and it
a,
was
question on cocoa here. Yeah, cocoa
yeah,
was one of the big leaders of the entire rally. I don't cover the softs all too much, but why
yeah.
not? Let's take a
Then
quick
Niagara
look at it.
Falls, and then Niagara Falls. Yeah.
And recently, we've had an run up in orange juice prices,
Oh yeah,
coffee prices.
yeah.
Sugar was going absolutely wild here for a while and has now, you know, paired all the way back. And should look at the daily nearest here so you guys can see, how far these markets really came. But cocoa, yeah, cocoa, which is a very can't which actually is wow, we're already back to highs here in the
Yeah.
September and July contracts. I did not even realize that. But cocoa is a very interesting market because it's primarily produced in one area of Africa and Ghana on that western coast. There's definitely cocoa produced in Hawaii and in the Caribbean, but nowhere near to the amount that it's produced in Africa. And so they're, outside the fact that this is a very thinly traded market that can get heavily moved around by large hedge funds and other big interests. Cocoa had a massive runoff, seems to be taking out highs again. I wouldn't personally be fading this just because it's so illiquid at times, it can just keep going. But when you have such consolidated production in one area of the world, if anything, shakes that up, you can get these very one-sided moves. But I would expect a very big breakdown in cocoa if it ever, finds a top here again. But
Drive two.
to just I think I had the softs there. Should I
Okay.
go back to them because
Was that cotton? The cotton
that
hasn't done
was
anything. Yeah.
cotton hasn't done much. We had a major move higher and has kind of fallen back.
Well, that's
Cotton's
good.
also kind of a barometer for the broader economy too.
Uh, I,
Um,
I don't want us to have to go back to polyester leisure suits. How
certainly,
about you? How
certainly
about
not.
you, Dan? I know
No,
you were too young. You never had one. All
no,
right,
I
there
never
you go.
did, but I agree with you. Cotton's a great product. There's demand out of India and China that might be questioned right now because of slowdowns in China that we've seen. So I'm attributing, the
Yeah,
fallback in the cotton prices to those slowdowns in China, which break into question demand for other products and raw goods. Copper and gold and silver may, be in question here too. Although, to kind of just touch on those markets real quick before we got to go, um, I definitely think there's something to be said right now for the strength in gold. I was watching the end of
yeah. He said
Grega
just
there,
buy
and
it.
yeah, and I tend to kind of agree with that notion. Another push down into that below 2300 to 2280, 2260. You can see the equal legs down. That's the 100% line, as well as a 50% line I've got up in my chart. That is
Yeah,
definitely the supportive congestion zone. I would be looking to be a buyer. I think there's something to be said that we could have a running flat that has just formed right now. If gold takes off and goes through highs, we'll all, as Elliott wave technicians, be calling this a running flat. That's an A wave, a B wave that goes to a new high, and then a C wave or WXY sometimes, that fails to terminate below that low. It's one of the more bullish signals in the chart. But with all that being said, gold was in a massive, upturn or massive move higher leading into 2020, kind of, initial inflationary move. We then found very sideways price action. It pulled basically into a 50% retracement from where it began that move around 1160 to 1210, right? We finally broke out of that. I look for
yeah,
negative 23% targets as a technical target. That was around 2300. We went above that level. And so now from highs to highs, I kind of see this as maybe a fourth wave extension, right?
yeah.
Forming up here and looking for another fifth wave to take us towards, 2600 or so. And I don't disagree with Greg. I think that And I kind of have a little more bearish stance on the dollar, but the dollar has been doing its own thing. The correlation between the dollar and the gold hasn't been perfect over the last 10
No,
years.
I mean, gold's
And I think
recent run and breakout happened with
absolutely.
the dollar rally happening simultaneously.
And I think the breakout in silver is the reason you really have to pay attention to metals here. We were in a much larger consolidative structure for silver. It was suppressed down for a lot of reasons that we don't need to go into today, but effectively, JP Morgan and Goldman Sachs that have silver hedges on, they sell silver, buy bonds. But we're finally starting to break out in silver. The last 2 months worth of breakout here are worth noting because we're finally pushing above the levels we couldn't since
For years.
2021.
Yeah.
And silver, an old trader, Dale, when I was at Rosenthal Collins years ago, big silver trader there told me, silver's the fat lady that sings. It's the last one to move. If gold's gone, you wait for silver to go. And when silver finally makes its move, which, are we targeting, the $50 highs that we've
Yes.
seen back in the 80s, and back in 2011? That's where this market has the ability to go if we start breaking out of this high.
Yeah.
You can see this congestion zone that we kind of held above, this rounding, really what is called a cup and handle pattern, in my opinion, forming. And the move up would target up towards 50. So when this fat lady sings and we go to 50, that might be, the time to start talking about the top for the metals. But before then, I find it really hard to get bearish, certainly in this economic environment, certainly in this Fed interest rate environment, for the markets to get too, I guess, I don't see the wet blanket getting thrown on the parade just yet, is what I'm getting at.
Okay. So Dan does full service brokerage. So you would
That's
actually
right.
have you'd actually have someone to talk to instead of just your mouse. Okay.
That's absolutely
So,
right.
and if you're trading commodity markets, you need someone who's on top of it because, you could go to the bathroom and everything changes. So, Dan, best way for people to find you if they're interested in trading these markets that are coming to life.
Yeah, you can I'm throwing my info in the chat there. I think it might need to
As,
be
oh, yeah, it's been
copied
there
over
on
to the others.
screen. Yeah.
But it's right in the bottom of the corner there, guys. You can
Yeah.
get in touch with me, 312-801-4231. Find me on Twitter, Facebook, shoot me an email, dhussey@zaner.com. Love to chat with you, if nothing more, just to have a good conversation. But yes, as a full service broker, you want somebody to talk with, work through your trade plan, be a sounding board. And certainly when, like Dale said, in commodities that are such fast moving, leveraged markets, to be that watchful eye over it. You're the captain of your ship. I'm the first mate and navigator is what I like to tell my clients. And so,
Okay.
captaining the vessel is a tough thing. If you can't sit in front of the screens all day, that's why you want to work with a broker that does something like that for and with you. So, uh, as always, Dale, thanks for having me on. And just one quick little last piece of info for people. This run up in the S&P and the Nasdaq, I think it's getting a little long in the tooth, but I think you've heard from me before. I think we're in a massive inflationary cycle like we're in the 90s. So, watch out. Recessions may not be as far down as you may think they will. But we are certainly heading into a period where you got to be thinking, about some form of pullback on the horizon. But I do think in the long term that could be a massive buying opportunity as well.
All right, Dan. And Dan's from Chicago.
Yeah.
So
Yeah.
that's
Dale
another
and I
edge.
cut from the same cloth of the Chicago futures
Well,
markets.
we were taught, I don't know, you're younger than me, but we were taught the golden rule, do unto others as you
That's
would
right.
have them do unto you. So,
It's such a small industry. Dale and I have known each other for a long time. We probably, 2 or 3 degrees of separation, know all the same people, and I have
yeah,
the same philosophy, which is I don't burn any bridges. I only build them, because
like that.
this industry is too small, and everybody knows each other. So you got to take care of each other.
Okay, don't tell everyone about me, okay, man, but about all my skeletons in Chicago. That's why I had to run away to California. No, I'm kidding. But anyway, listen, Dan, thanks for being here. Great discussion. And
Thank you for having me.
we'll talk late summer, early fall again.
Yeah, we'll set it up again, everybody. Thanks for having me.
All right, Dan Hussey, everyone follow him on X. check them out at Zaner Ag Hedge and, consider this asset class to be still the undiscovered one. So thank you, everyone. We'll wrap it up tomorrow for TGIF. Good luck the rest of the day. And remember, don't just count your bushels or your cocoa beans or your stacks of wheat or your coins. Count your blessings and have a great day, everyone. Live it. Thanks, Dan.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.